For those of you who follow GameStop pretty closely, you probably heard that the company has decided to do what's called a secondary stock offering. A secondary stock offering means that the company is already public, its shares already trade on the exchanges, right? And now they want to issue more shares to raise more money for the company. An initial public stock offering means that the company's private, and this is the initial, meaning the first time they're going public, first time they're selling shares. So a secondary stock offering means it's already public, now they're issuing additional shares. So think about that. So right now, there is a certain number of shares that are out there trading in GameStop. And then to find out what the company is worth, in terms of what investors are saying it's worth today, right? What you do is you take that number of shares and you multiply it by the current price of each share, and you get to this big number called the market capitalization, meaning what the company is worth. You take every single share out there, multiply it by the price of each share, that's what everything is worth in one, right? Now, I predicted that this would happen on virtually every major news network. To my own people who follow me, I said, guys, one of the biggest problems here with GameStop, for those people who are playing the so-called, let's hold the line game, and I love you all, and I'm behind you. I just want you to always know both sides of the story. You need to understand the dangers here and why you can't look at GameStop in the same way you look at Bitcoin or Ethereum or something that's in the crypto world. So the point I brought up a few weeks back on every news network out there and with my own people was that if the stock of GameStop stays up much longer at this inflated price, then all that's going to happen are two things. One, institutions that own lots and lots of GameStop will blow out and they'll start selling. They'll sell into this insane top of the market buying at the inflated prices, number one. Number two, even more troubling, is the fact that the company will start to issue more shares. They will announce a massive secondary offering and dilute out the current shareholders. Now, let me repeat that again. In other words, right now, let's just say there's 100 million shares out of GameStop, and I'm just making up a number, okay? I'm not sure the exact number. It doesn't matter. 100 million shares, okay? So if they get to issue more shares, what happens? Remember, stocks trade based on supply and demand. So if there's 100 million shares out there in the trading float, and it's probably less, doesn't really matter, but they issue 20 million more shares, you're adding on supply. So that's depressive. It's going to bring down the price of the stock. So what happens is when stocks stay up too long at unrealistic values, the people who are running the company, the management, the board of directors, they look and say, wait a second, we could use this as an opportunity right now to raise money. If the stocks are trading at $180 like it is today, or $170 today, right? And the stock's really worth $10 based on the balance sheet, say, damn, I'll do that all day long. I'll sell stock at $180 a share when I have a $6 book value, or whatever the book value is. Why not? It's theoretically anti-dilutive fundamentally to the company, because you're raising money at this really wildly high price that the company's not really worth. The problem with that is all the short-term investors who are playing the hot money game, the story stock game, when those new shares are announced and they're dumped on the market, it will send the stock lower. Because what's happening is now that's a very, very ultra long-term strategy that the management is playing, and it's the correct one for them. They're saying, hey, we can use all this money now, and we can retool the business, change it, do whatever we need to do. It's like, they have a war chest of cash. So while it's good for the company itself, it's a smart decision for the management team and the long-term prognosis. It's very depressive on the short term, on the price of the stock. Because suddenly new shares become available, and why would you here's another point. I learned this the hard way in 1989, a long time ago, before many of you were actually even born. I had a stock that I was battling the short sellers with, And I stupidly announced a secondary offering. I announced that we're going to raise more money, and all of a sudden, everyone started selling this stock because when secondaries come on the market, you're increasing the supply.